A quick sound check here, make sure we are good to go. I think we are, just double checking. Everybody's getting logged in, fantastic. And got all this here. Okay, so looks like it. We got this, yay. All right, so welcome everybody. And this is Facebook Live. And what I'm going to be talking about here is a trade that I was in back in March. And I was in it for about almost a month, which is a little longer than it's, kind of a normal trade. I mean, I'm not a scalper or anything like that. I typically am in a trade for either 2 to 5 days. That's kind of a sweet spot. Or I'm in the trade for about 3 to 5 weeks. Those are the two kind of trades that I like. And what I want to talk about is just that, this is the biggest trade I've ever done. Last year I had a number of big trades on Tesla. This year Tesla has not been a good stock to trade in my opinion, but based on the setups that I use. But this trade turned into one of the 3 to 5 week trades. And I just kind of want to go through and talk about it because it was a hard trade to hold on to. And so a lot of what I have found is being able to make money trading is learning to sit through the wiggles, learning to sit through the emotions and the anxiety and the frustration and even sometimes anger that you might have, and just make sure that you can recognize when you need to get out of a trade because it's no longer working versus simply getting out of a trade because you can't stand holding the emotion anymore. And if you get out of a trade because you can't stand holding the emotion anymore, really the market is going to have its way with you versus, being fairly clear on what's working. So let's dive into that. So I do keep an eye out for setups that have the potential to be big trades. There's a part, if there's not much going on, I've got a simple, my simple premise is, if there's nothing really going on, I can sell some put credit spreads, make 2.5% a week, and I'm happy. I'm happy doing that. But while I'm doing that, I want to be on the lookout for potential bigger trades. The idea with this is that, you want to have an equity curve that's kind of going from the lower left of your screen to the upper right. And if you're cranking out 2.5% a week, that actually turns into several 100% per year. The key is, you're not having any big drawdowns. But what I like is having that steady up move, and then every once in a while I have a hockey stick move up, and then followed by more steady up moves, and then another hockey stick, meaning that once in a while when things come together, I want to be in that trade. And for this, it was Google. Right now, it's been gold and silver. Gold and silver has been a fantastic setup. And, in Q3, who knows what it will be. But on something like this, what I'm looking to do is take a bigger risk. And I never bet it all on one trade. But, if you put 20% of your account into options, that's a lot of leverage, right? It's a lot of leverage. And so that's what I'm talking about here. Most of my trades, I'm risking maybe 5% on a position, but, more, sometimes 2%. But I do, when I'm looking for the stuff, the right stuff has to come together for this. So last year, this happened multiple times with Tesla. But Tesla's a different stock this year. It's just every stock goes through different personality changes. And, Tesla for me is just another stock at this point, nothing special. So, and I'm not looking for the new, the hot meme stock of the day, right? It's like, yeah, it was great. GME had a great move, but I'm more interested in sustainable setups that can be used over time no matter what's going on in the market, whether it's going up or down. I'm not dependent on a group of people getting together for a short squeeze. And, there's pros and cons of that. I have nothing against it. But, you've got to know your entry point. You got to know your exits. And sometimes what I've seen is people will get, they'll buy GameStop or something like that. And then it becomes more of a mission. Instead of a trade, it's, I'm, diamond hands. I'm holding this forever. The people that bought tulip bulbs at the top are still wondering, or their ancestors are still wondering why they did that. Why didn't they get out, right? So it's all about the setup, the setup. I don't really care what's happening in the news. I don't watch the news. It's a waste of time, in my opinion. The charts tell you everything that you need to know. So given all that, in March, as I was going through setups, the one stock that really stood out to me was Google. Okay, and so why did it stand out? So Google was a fairly textbook-looking squeeze on March 11th. Okay, so I kind of deliberately covered all the price action past March 11th here. So March 11th, this is what I was seeing March 11th. Okay, none of this had happened yet. So I'm looking at this. The stock's taking off. We're at these bands are Keltner channels. So this is +1 ATR and this is -1 ATR. That's what I call the buy zone. And as long as it's in between those bands, that's fantastic. So here we are. We're right at the top of the buy zone. We've got a squeeze. And what I really liked about this is during this time, if you guys remember, the NASDAQ was falling apart. While the NASDAQ was falling apart, Google was holding up really, really well. And so I like the combination of A, Google was a strong stock against the backdrop of a weak market. B, we had my textbook favorite squeeze setup with an RAF ready, aim, fire long. So all of this was coming together fantastic. So this is a hugely positive sign for a potential big trade. And on this, I never go all in at once. I'm a huge fan of scaling in. So what I did here is we do have a trading room where I like to post out these alerts. And so this was on March 11th and said, all right, I am going to sell some put credit spreads on Google and I'm going to buy some call debit spreads on Google. And you can see these are pretty wide. That was $100 wide. And then sometimes people ask, well, I've got a smaller account. I can't do one that big. What do I do? And so I also set up some trades for smaller accounts as well. Now, lo and behold, the very next day, Google is down $55 a share. Okay, so now it's like, great. Day one, I'm getting creamed in this trade. What do I do? Well, if we look at this, remember what I talked about. The buy zone is between +1 ATR and -1 ATR. And all we did was go from +1 ATR back to the mean. And that was it. And you can see here the average true range of the stock is about $50 a day. So a $50 down move, while it was not what I was expecting or looking for, there was certainly nothing to be alarmed about. It's like, okay, is this trade over? No, it's not over. So what I did here is I added to the position. Right? Wow, we're $50 lower. I still love the setup. I'm going to buy the 2100 2250 call debit spread on Google. So then Google proceeds to lose money 3 days in a row. And at this point, I'm on spring break vacation with my kids in Mexico. And you can see here, we just keep going down, down, down to -1 ATR. So basically, my trade is not working out at all. And in fact, it's starting to hurt a little bit. So this was frustrating. And as I looked at this and thought, man, do I need to cut this? Is this trade just not working? Because trading is all about probabilities. Nothing works 100% of the time. But you know, if things can work 75% of the time, that's great. But that still means that 25% of the time, they're not going to work. And so as I looked at this and thought, wow, this one's just not working. It's just not time yet. But when I looked at this, nothing was wrong with the setup, okay? Nothing was wrong with the setup. The setup is valid. We're still in the buy zone. You know, everything looks great. Now, during this time, I also had a trade on GameStop. GameStop was crazy volatile, and so it helped kind of put it in perspective. GameStop fell like $100 a share, which was 30% of its value, whereas Google's fall was something like 2% of its value. So it helped to put that in perspective. So ironically, my week on vacation has been my worst week of trading in all of 2021. Now, it was my worst week and it was open losses. You know, it ended up getting made back up, but I do track my equity day to day and week to week. So I didn't trade, I just held on to that. I had a big position in Google and I had a small position in GameStop, and both of them didn't work during my spring break. And so, I was trying to focus on the beach and have fun. And, in hindsight, it would have been better to wait on Google and just enter it when I got back into town. But hindsight's 2020. We never know when a setup is going to trigger. Okay, I knew that the setup was there, and I just had to be patient. And in fact, instead of getting out of it, I was thinking, you know what? This thing is still valid. Okay, there's nothing wrong with it. I like the setup better than anything else in the markets right now. So you know what? I'm going to add to it. So now here we are. I'm picking up some 2100, 2200 call debit spreads. And again, this was posted in our trading room on March 22nd for $21.68. The 2150, 2250 is at $11, and then selling some more put credit spreads. So again, continuing to add to this position while it is maintaining the integrity of its structure. So at this point, while Google was holding its own, the other key part of this, and this is something I always try to remind people, is that you really got to keep an eye on the indexes. You can have a stock that you love. It looks great. But if the indexes are not cooperating, it can be very hard for that stock to get going. So even though Google is holding up, even though Google is bullish, if the NASDAQ continued to sell off, it was unrealistic at that point to expect that Google would buck the tide and rally. So what I really needed to do was continue to really dive into the NASDAQ futures and see what was going on. And the pattern I was watching here, and I'll post a bigger chart of this, but on the 29th in the room, I posted this chart and I said, look, this is the key pattern I'm watching unfold on the daily chart. This is the daily chart on the left, and then a 7 to 8 minute chart here. And again, I'll blow this up here in a second. These patterns, so these are head and shoulders patterns. These patterns are a pain, as you never know how long it will take for them to play out. But at this point, a close above 13,000 on the NASDAQ would get the ball rolling for a possible move to plus 2 ATR, which would be 13,600 over the next couple of weeks. And so we picked up some NASDAQ futures as well while waiting for Google. So here's a zoom in here. You can see we got this great head and shoulders reversal on the daily chart of the NASDAQ. Got a great looking squeeze. And what I'm looking for is that we can actually push through this and get to plus 2 ATR, which is 13,600. Now in that situation, I would expect Google to be a champ. Google is holding its own. Yes, every stock is going to go up if the NASDAQ breaks, but Google should be the strongest because of its structure. While the NASDAQ here was falling apart, remember, Google's trading sideways, and it's just gathering, gathering energy, building up momentum for a move, all right? And so that's what I was excited about. So I'm still, trying to get my hopes up on this trade. So Google started rallying off its lows for 3 days in a row into March 23rd, okay? On the 24th, it started off strong, and then it started to sell off, and then it turned into yet another losing day for Google. I remember on this day too, we have a couple of horses that we like to, ride and train. And we had a horse that day that broke its leg and we had to put it down. And this was during market hours. And it was a really, and I try to keep a journal of what's going on. And in my trading journal, I just wrote shittiest day in a long, long time. Not only was, Google still, here we are, 2 weeks later, and it's still just can't get it together. And then, this on top of it, it was just like, man, this is brutal. And we've got him buried out in the field, and it was really just a bad day. So then we get to the next week, and the next week is hurry up and wait as well. Everything is trying to bottom, and again, this was on March 25th. It's like, all right, as we head into the afternoon, the NASDAQ flush appears to be done, and let's see if this thing can get its act together. And then on the 26th, all right, it's looking a little bit better. If we can get a close above 13,000 by Tuesday, it sets us up for a strong April and a possible retest of the highs, but it has to show that it is at least willing to get something going. A strong close today would set the tone. I'm still sitting on Google, which is like waiting for Godot for the time being. It needs a close above 2050 early next week to get the ball rolling. So basically, I've just had 2 weeks of suffering sitting in this trade. It's like, all right, so what do we do? So on April 1st, we got the NASDAQ breakout. The next week after all that, really nothing happened. And then finally on April 1st, we get the NASDAQ breakout. Google also took off, closing the day at 2130, about 15 points below its all-time highs. Trading wise, Google was finally back to being profitable after being mostly negative since I entered it on March 11th. All right, so now, wow, I'm back to being positive on the trade. Do I take the money and run and repurpose that capital into something else? I got my money back, or hold? And again, if we go back here and we look at this, here's when I got into this trade, and in hindsight, it was early. The setup was there, but I had to hold through all of this, which was really painful. It'd have been amazing if I could have got in right here. But now here we are. This is the moment I was looking for. So I don't want to bail. I don't want to bail now. Okay. Now I was up $400,000 by now. So after all this pain and suffering, it's like, wow, I was basically down on this trade from day one, and now I'm up $400,000. Should I just take the money and run? But the thing is here is that, anxiety and annoyance and the feelings that a trader is experiencing while in a trade has nothing to do with the trade. It's all about just managing the ego. The ego doesn't want, it doesn't want that. It doesn't like that. And you just kind of have to realize it's completely separate from the trade itself. So in this case, I did nothing. Is the setup still valid? Yes. Do I need to do anything? No. Hold. Is it possible that, this is the best price that Google's ever going to see, and from here we go straight down? Of course, anything is possible in the markets, but the setup structure is a high probability setup, and all we can do in these situations is play the probabilities. Now, in addition, the markets were breaking out. Amazon started to look good too. And although I didn't want to add another big position because I already had my hands full with Amazon, I was willing to add a regular 5% position. When I say a 5% position, I just simply mean I'm going to buy calls or sell put credit spreads or buy call debit spreads. Whereas if they went to zero, I would lose 5% of my account. So I wouldn't necessarily sit there and watch them go to zero if it wasn't working, but I at least know how much I'm risking. So I'm risking 20% on Google, 5% on Amazon. So, and the setup on Amazon here was very, very similar to the setup on Google. The setup on the NASDAQ, which was nice. So on that kind of a situation, I liked it because you had the same reversal pattern. It's showing positive moves here. So it's a different trade than Google. Google to me was bullish in and of itself, and it just needed the backing of the NASDAQ. Like Google was like, you know what? I'm going to hold here. I'm just waiting for the NASDAQ to get its act together. Whereas Amazon was following the NASDAQ. But now since it's like, okay, we're breaking out, fine. I'm willing to add to this. And plus it had a squeeze as well. So for Amazon, as I typed here in the room, I'm going with a 6% position. And I'm going to spread it out across a $100 wide debit spread, and then a $25 wide and a $10 wide. So the $100 wide is for larger accounts, and then the $25 wide is for medium-sized accounts, and then I posted the $10 wide one, which is meant for smaller accounts. And then my positions going into the weekend, basically all I had was Google and Amazon, and I just made a note that, that was for my diversification, LOL. So the markets were closed on Friday. So this was a long 3-day weekend. It was Good Friday. And it was a long weekend because it's like, wow, sometimes when you got these positions on, 3 days can seem like forever. Well, what happened when the markets finally opened on Monday? Would things get going again? And Monday happened, and it was a phenomenal breakout. Google's up $90 to new all-time highs. Amazon is up $70. Everything looked great, and I decided to continue holding. I spent all day not looking at the P&L, but I knew it was a big day. So what do I mean by this last line? So when I started trading, I did a lot of scalping of the S&Ps. And what I found eventually is that if I was looking at the P&L, it would always mess me up because I'd be scalping. I'm like, oh, I'm up $1,000. And then, it might show then it's down $200. And that would mess with me. And what I found was I would actually tape a business card on the corner of my screen and cover my P&L. So I still do that to this day, because watching the P&L, especially as you get bigger and bigger numbers, watching the P&L during the day can really mess with you. Instead, what I do is I watch the chart. And it's like, well, the chart looks good. And then that way I'm not freaking out on these P&L fluctuations, because I've been trading a long time, but as you trade larger and larger sums of money, you still got to get used to the fluctuations, and the fluctuations oftentimes can mess you up. So after the close, I realized, I finally looked at the P&L and it sank in that Google was now my biggest trade ever. And so I had positions in 2 accounts, and in my Thinkorswim account, my positions were up $4.2 million, which was amazing. And then in my Tastyworks account, they were up about $800K. Now, I had trouble sleeping this night, and that's rare for me. Usually, my saying is that I don't sleep really well unless I have positions on. But now I was worried, what happens, if I wake up tomorrow and Google's downgraded and my $5 million profit, biggest trade in my trading career, is cut in half, or is at worst goes back to being a loser. I was like, ugh. So I knew the next day I needed to kind of start thinking about, easing out of this trade a little bit. And so that is a legit kind of a thing. But also too, it was near my target. So my target on this was 2250. Which was that 3 ATR level. And we were, within $20 of that. So, yes, I could make more money if it would continue going higher, but the bulk of the profits were made since these were all spreads. Basically, if I could hold it into expiration, I could make another $1.5 million, which, don't get me wrong, that's great. But expiration at this point was 2 weeks away. So it's like, gosh, you know what? I think it might be time to take the money and run. So on Tuesday, April 6th, I wake up, and both Google and Amazon, it's a quiet day in the markets. The day before had been such a big day. And they're both up about $10, and then they're down a few dollars, and then they're down $15, then it's back to scratch, and this went on till lunch. And at this point, I got objective, and I started looking at the charts. And it's like, all right, I couldn't sleep last night. Google is basically at its target. So what I'm going to do is I'm going to close out the call debit spreads, which is where the bulk of the profits are, but then I can keep the put credit spreads and continue to collect that theta decay on those positions. And then Amazon had room to move, so I could keep that. So here's where we were. So when I talk about, we're at a target, we're at 3 ATR. Here's the mean. There's 1 ATR, 2 ATR, 3 ATR, and ATR, if I didn't mention it earlier, that stands for average true range, which is an indicator that's on every platform. So here we are at 3 ATR. You rarely go much past that. You can see right here, it's like, oh, we're at 3 ATR, and from here, it traded sideways for a while, and here we are at 3 ATR again. So I wasn't expecting it to go to $2,400 or anything like that. So at that point, it made a lot of sense. And so I, again, 2 accounts. This was my Tastyworks account. And my total Google profits here on my call debit spreads and put credit spreads at that point was $818,000. And then for Amazon, it was $400,000, right? So nice solid profits on those. And then for Thinkorswim, for Google, this is a bigger account. I had my call debit spreads, and some of these call debit spreads, I bought them at $9.50, and here they are at $57, right? So this was at the time, a $4.3 million trade. So just over $5 million across both accounts. And again, I cashed in the call debit spreads. I kept the put credit spreads, which actually continued, decaying, and so I got to continue collecting that. So it actually ended up being a little bit more than that, but it wasn't, a nominal amount. So although this trade was a lot bigger, so last year my biggest trade ever was this trade on Tesla, and it was a $3.7 million trade. The trade on Google was way harder to hold on to because I had to hold on to it for, let's see, let me get my pen here. So for Google, I held on to this trade for 3.5 weeks. And for Tesla, I held on to that trade for 3.5 days. So 3.5 days, holding a big position for 3.5 days is a lot easier than holding a big position for 3.5 weeks. So that's just, as a trader, it's that training to get used to, again, the anxiety, the uncomfortableness of sitting in a larger position. And Google really tested that. Now, if during that whole time all I had on Google was a little 2% position put credit spread, I would not have had the same ups and downs and and the doubts and like, oh my God, what's happening here? But because it was a bigger position, because it was based on directional, there was that, okay, is this thing, I really don't want this to turn into a disaster. And, it wasn't working for the first 3 weeks, but again, there was nothing wrong with the setup. So it was like, okay, patience, patience, patience. Generally, for larger trades, I do plan on holding them for a shorter duration simply because it's easier to hold on for a couple of days versus, nearly a month, looking for kind of that quick pop. In this case, it did drag out for much longer than I thought it would, but the main point is that the setup was never invalidated, okay? And I'm willing to hold on as long as the setup was valid, and that was my mantra through this. And which, as a trader, is the best you can hope for. You don't want to get tricked by those pesky emotions. So for Google, on April 6th now, coming full circle, I'm posting the exits. We're getting out of the call debit spreads here for 78. These call debit spreads for 70. These call debit spreads for 55. And then also keeping the put credit spreads at that point. So on April 7th, so now, I'm finally out of those trades, the debit spreads. Last night I slept well. This morning, Google is trading up to around 22.30, so I would have made more money had I held on to all the call debit spreads. But, of course, I still had the put credit spreads, and I still had Amazon. So I'm still participating in the NASDAQ move. Now, in hindsight, was it a mistake to sell? And it wasn't. It wasn't. I was at 3 ATR. And at that point, the risk to reward was skewed. It could go up a little bit more, but it could also go down a lot. And there was no reason to get back all those profits. So getting out, even though I would have made more money had I held on, getting out was the right call. And it's hard sometimes when you are in the thick of it and it's the biggest trade of the career. And you're thinking, like, what are some of the questions there to consider? And I always like to review this. This is part of my trading journal. I'll say, in this case, did I get out too early? And the answer is no. I didn't bail when things were hairy, and when I did get out, I was at 3 ATR, and I'm happy even to get out at 2 ATR. So 2 ATR would have been a much lower target, but in this case, when you have a squeeze and you've got a strong stock and the indexes are all cooperating, 3 ATR is a legit target in those scenarios. Was it too big of a trade and did I get emotional? Yes, it was a bit too big. And maybe it wasn't that it was big, it's just that it dragged out for so long. I had to pay attention to it during vacation, okay, and that's always a red flag. I'm like, why am I doing this during vacation? And it was starting to impact my mood the longer I stayed in it. Smaller trades don't do this to me. And so part of trading is always continually pushing your self-perceived limitations. I've got a friend of mine, he's a great trader, and he trades, more from a personal account, more money than almost anyone else I know. I mean, we're talking, my trade in Google was nothing for what he does. And he does more shares. He doesn't do as many options. And we talk about that sometimes. And he's like, John, what's the difference if you're trading $1 million account or a $10 million account or a $100 million account? It's just an extra zero. What's the big deal? He's like, just look at it at percentages versus dollars. And he's really right about that, because what happens as traders is that, especially as you start trading a little bit more, you might think, oh my God, I lost $45,000 today. That's a teacher's salary. Well, if you're trading $1 million account, that's 4.5%, and that's how you got to think of it to say, keep your head on straight. If you're trading a $100,000 account and you lose $5,000, you might think, man, $5,000, I could have bought a sweet TV and sound system with that. Well, you don't want to think of it like that. You just think of it as percentages. And then once it becomes percentages, it's just movement, and you really want to get your arms wrapped around that. And it's so important. Is there anything I would have done different? The only thing I would have done different is just patience with the entries, trying to buy closer to the mean. My first entry was at +1 ATR. So again, there's 1 ATR. Here's the mean, which is the 21 period exponential moving average, and -1 ATR. And my first entry was here. And I bought there. It was still in the buy zone because I thought at the time, man, we may not come back to the mean, and I don't want to miss it. In hindsight being 2020, had I been more patient, had the bulk of my entries here and here, I would have been less agitated, and of course my profits would have been better. But I don't, you just don't know. And the thing about it is with trading, you do never know when it's going to take off. Now, here's +2 ATR and +3 ATR. I would never buy at +3 ATR, and I'm not going to buy at +2 ATR. That's chasing. This is the buy zone. So I basically bought at the top of the buy zone, the middle of the buy zone, and at the lower part of the buy zone. So my average price was actually pretty decent. So again, and the other thing too is, you can make a lot of money trading not being perfect. And I would say this year, last year I probably had 5 trades that were worked out about perfectly like I thought. This year it's probably like 3, Google, gold, and Amazon, and a couple of others. So what now? Here we are, and this is from April 7th, but now it's May 17th. What now? Are there any big setups right now? And for the markets, what's interesting right now, the couple of things I'm seeing is that, we've had a lot of upward movement in, NDX, that's the NASDAQ, Bitcoin, okay, BTC. And I am looking, Bitcoin at this point has rolled over. I think it's going to 29,000 to 30,000, and it'll find support there. The NASDAQ, believe it or not, I think has one more push higher into June. And then from there, I don't think we're going to see the highs in June for 6 months. So just keep in mind, if you're newer to the market and you're just buying the dip, understand that does not work all the time, and everything moves in cycles. And that includes crypto as well. Anything that's being traded by human beings always has these cycles. And I don't think this move from 60K in Bitcoin to 29, 30K, it's a disaster for anybody who used leverage and bought it at 60K. But I do believe in this long term, and I dollar cost average. And I think the idea that it could go to 100,000 or higher is realistic. But it's the same thing like Google. I'm not going to hold on to Google forever. And with Bitcoin, I'm going to watch the charts and see how it acts. And I think, you got to have a healthy, you want to look at it as a trader and not get evangelical about it. It's just a trade. Yeah. And people in crypto, of course, get very, very, intense about it. Diamond hand, I'm going to buy GameStop. I'm going to buy Bitcoin. I'm never selling either. Well, I understand that, but things change. And so we do want to kind of keep an eye out for, when do things change? When do you convert to another opportunity? By the way, I think buying crypto and holding for the next 5 years is one of the greatest trades on planet Earth. So, I would keep buying Bitcoin and Ethereum and keep an eye out for stuff that way. Okay, so I'm happy to stick around and answer questions if I can. And then, but I did want to, for anybody that's looking at this and going like, wow, that was cool. I didn't even know you guys had a room. There's a link here. It's kind of long, but if you type in simplertrading.com/join/options/trial-2, that will get you a trial to the same room where I posted the Google trade. Right now, I've been posting trades on gold. I really like gold and silver here, GLD, SLV. I'm looking for some pretty decent moves there. We did sell some put credit spreads on GameStop today and a few other things. So the markets are always changing. And as a trader, I'm just looking for where is the highest probability setup to make money. Okay. Sometimes that is GameStop, but I don't have diamond hands. I'm not going to hold on to everything based on some evangelical conviction that I read on, Wall Street Bets. I just do it based on technical setups, based on high probability exits, high probability entries. And I don't really care what the stock is or what the instrument is itself. Let's see. And then and we can look at and I'll show you, I'm going to leave this up here for a second, but I want to show you real quick the gold chart, since it's a similar move. So here is, this is the NASDAQ. I'll change it to gold. Yeah, and Al, I see your question there too, and I'll answer you on that one. So Google, I just wanted to show you this real quick. So on a daily chart, so this is Google, gold. So gold futures, we have a squeeze here on the daily chart. You can see it's fired, and we're pushing up through this 200 period moving average. I am looking for us to get up to the 1920, 1950 level, because in addition to that daily squeeze, we also have a weekly squeeze. And the weekly squeezes here get pretty exciting. You know, when they get going, you can get some pretty decent little pops. So you can see here, so again, I'm looking for like about 1920 or so. If you trade gold futures, you can do it that way. Or you could trade GLD, which is the ETF for gold. And on GLD, keep in mind, you're not going to see the same setup because GLD only trades 6.5 hours during the cash session. With volume, because after hours it doesn't trade very much volume, whereas gold futures trade 24 hours. And so on this, I'd be looking for about 180. So it's not super exciting, but I think it's one of the safer trades that are out there right now. And then, and so Al's asking, is there any way your Google trade could have been successful with just long calls? The answer to that is yes. I'm not against just long calls. So on a long call, of course, what you're up against on a long call is the idea that you've got to deal with theta decay, right? So if you just do a long call, here's the two things I can tell you. One, give yourself the gift of time. So if you see, so here is the setup in Google, right? So let's say that you bought calls right here that expire in 10 days. Well, you would have lost all your money, right? But if you had bought calls that expire in 30 days, you would have been able to sit through this and let this play out. So during this, I did have a few just long calls as well. And the reason I did debit spreads was just so that during the chop, it wouldn't be as painful. But to answer your question, when there is a squeeze, that is a good time to do long calls, but pay up to give yourself more time. If you've got something that's, especially with a daily chart, that's the biggest mistake I'll see people make is they get excited and then they buy some cheap out of the money calls that, expire in 10 days. And it's just like, you're just playing with fire at that point, because then it becomes luck, versus a skill situation like that. Oh yeah. So, and, hi, I'm new to your community. When you mentioned 2 ATR, 3 ATR, etc., you are referring to the Keltner channel. Correct. So let's come over here and we'll look at gold, since that's a trade I like here. So I'll bring this over here. And if we look at gold we've got the weekly chart on the left and the daily chart on the right. Okay. So you can see here on the daily chart, we're getting, 3 ATR is moving up here. So it's like, okay, we're getting close to a target. Oh, sorry. You guys probably can't see that, right? Let me squeeze this in. There we go. So on the daily chart, we're getting close to 3 ATR, but remember the weekly chart is pretty powerful. And we can look at it on Google too. But the squeeze here hasn't even fired yet, right? And so I am looking at that we could get to 2 and 3 ATR on the weekly chart. And so all these are Keltner channels, and it is 3 instances of the Keltner channel. So literally, I've got one set of Keltner channels set at 1 ATR, and then a second set of Keltner channels set at 2 ATR, and then a third set of Keltner channels set at 3 ATR. And that way, because basically what happens if you get to like minus 2 ATR, the odds are really strong that we're going to go back to the mean. And if you get to plus 2 ATR, the odds are really strong that you're going to revert back to the mean. And so it keeps you from chasing, it keeps you from panicking, et cetera, et cetera. So Nick is asking, for credit spreads, are there any tips on not panicking as you need time? would you have closed Google out if it closed below 1 ATR? Okay, so that's a good question. And that's the toughest thing, and that's why I wanted to do an in-depth study on Google, because it was a hard trade to hold on to. So I want to give you so if you understand what a clean setup is, and this is just a really clean setup. You've got a squeeze, you're not breaking any structures, et cetera, et cetera. So what would cause me to want to get out of it? And so since we didn't happen on Google during that time, I'll show you, gosh, I'm trying to remember exactly what this trade was. It might have been Amazon. Was it here? Well, so there's a couple of things with this. Is that when you see that here's a squeeze on Amazon, right? But when Amazon's holding minus 1 ATR, it's holding minus 1 ATR. Now, when it falls through that, that's generally a bad sign. Now, here's the thing. If you own calls, okay, let's say that right here, you bought some long calls that expire in 20 days. Well, you're screwed at that point, okay? But then let's say that you sold a put credit spread down here that also expires in 20 days. The put credit spread will often be very forgiving. So even if it blows through it, if you've still given yourself enough time, it'll oftentimes revert back to the mean. Now, that's not going to help the long calls you bought here, but you could still see your put credit spread go to max profit. So the secret, I think, to spreads is that you just put on an amount and make your stop loss max loss. So you know how people will say, okay, I'm going to buy a stock at 200 and my stop loss is 195 and my target is 205, right? Or whatever. So, it gets to 195 and then they're stopped out. So basically they were willing to risk $5. Well, if you looked at credit spreads the same way, so say you did a $10 wide spread and it was slightly in the money and you're able to sell it for a $5 credit, which means your stop loss is $5. Well, what's nice about this is that with a stock, if you go down $5, you're done. With the spread, you're going to lose $5 even if it falls 1,000 points, right? You're not limited to that $5. So you can give it that room to let it blow through it and then revert back. Now, are there times when that's not going to happen? Of course, and it just depends. So it's one of those things that I look at. If the chart structure is if you're bullish and you're selling put credit spreads and the chart structure is fine, great. But what's an example of a chart structure that's not fine? I would say something like DoorDash. This is just not. You can see all the lines. See how the lines here? They're all pointing down. I mean, this is just telling you this thing is just it's just not doing anything. So there's that possibility as well. Or gosh, what was another one? TTD. When is a stock done? And when I look at something like on a daily chart here, right? One of my rules of thumb. First of all, if I'm going to be bullish on something, you see these bars here. These are called 10x bars. And if they're green, it just means that the ADX is over 20 and momentum is positive. And if they're red, it means also that the ADX is over 20, but the momentum is negative. And then yellow is just ADX, there's no trend. So when the 10x bars go red, at that point, I'm often like, okay, well, is there any reason to buy this anymore? And you can see there that when that happens, yeah, it kind of comes back up. But it's important to study a chart like TTD. This is what a top looks like. I mean, this almost looks like the NASDAQ 2000 crash. You have this nice move up, it comes down, and then everybody gets excited again because it's going to go, and that's kind of the bull trap, and that's when everybody gets destroyed. So, if you're wondering if your stock is falling apart, study TTD. It's a classic crash, done stock. This stock, I would bet this stock will never see this price again. This stock is just done, and it's going to go back to, you remember for a long time, this was a sub $200 stock, and it's most likely going back to that. So it had its moment, and now it's done. Is that a Fibonacci, Bollinger, Keltner channel? No, so it's not Fibonacci based. It's just, again, it's just normal Keltner channels, 21 EMA, and then 1, 2, and 3 ATR. So it's 3 sets of those. Matsus, sorry if I mispronounced your name. What would you say to a 20-year-old self-based, what you know? Okay, if you're beginning. Okay, so if you're beginning your trading career, so what would how would you do it? Would you do anything different? So the biggest thing is that trading is a skill. And think of your last. Just think of if you had to show somebody your statements for the last 12 months, and that's your resume, okay? Because if you can learn the skill of trading, you can find money to trade. So if you think of it that way, trading is kind of a lot like golf. I'm not a huge fan of golf, but I played it before I had kids. And basically, when you're swinging a golf club, if you're totally focused on the swing and releasing it, at a certain tempo, the golf ball kind of takes care of itself. Versus if you're sitting there going like, oh God, I hope I can hit this really far, and then you kind of screw it up. And it's the same thing in trading. If you just focus on the setup, it's like, okay, this is what I'm looking for. I found it. I'm going to ease in. I'm going to ease out. The biggest thing I've noticed is that a lot of times people don't really fully appreciate the psychological aspect of trading. And so if there's anything I wish I would have found sooner, it is the book by Mark Douglas, which is called Trading in the Zone. And this sets you up psychologically to handle the ebbs and flows of the market. And then from there, just remember, this is a probabilities-based game. There is no certainty. One of the things he told me, and I worked with him, is that don't think of it as one trade. Do 25 trades and see where you are. So, a lot of times people get into a trade and they think like, oh my God, this is the be-all and end-all of the rest of my life. And it's not. Do blocks of 25 trades. And at the end of 25 trades, did you make money or not? And it's a huge thing, because then you start focusing on the setup. And let's see. Blind pig dog. I love it. Are your Keltner settings 20 period with a 10 period ATR? So here, let me, so my Keltner settings are 21 EMA, and you can do 20 if you want, but I do 21 exponential moving exponential. And then I do the default 14 period ATR. And then I do three sets. So I do one at 1, one at 2, and then one at 3 ATR. And that's how I set those up. And they work really well. I mean, it's a very simple thing, but visually it'll keep you from chasing, and it'll keep you from panicking. Harley's asking, what is your criteria to scan for setups? So for me, if we go back to, let's see, what's the setup here? If we go back to, so basically the main thing I need to have is a squeeze. So if I let's look at XLV. This is not a trade I'm in right now. And if I look at XLV on a daily chart, this is what I've been watching, and I say like, okay, I only get interested when there's a squeeze. Okay, so why is that? Basically, so you can see there, it's hard to see, but there's a squeeze right here too. But when it fires, generally after it fires, which is the first green dot after the series of this case black dots, that's when you get your biggest move. Okay, if the histogram is above 0 and it fires, you're generally going to get 8 to 10 bars of upward movement. And if it fires negative, you're going to get 8 to 10 bars of downward movement. So in a perfect scenario right here, I would buy XLV at the mean, okay, which is 122.18. And when I say buy it, I could buy the XLV itself. I could buy in the money calls. I could buy a call debit spread. I could sell a put credit spread, anything bullish. And then with the expectation that this would fire long since the histogram is above 0, and then we would go back to 3 ATR. Okay, so not a huge trade, not super exciting. 3 ATR is $125.72, but I would call that a textbook setup of what I like to look for, and that's probably a trade I'll take. TTD stock split. Well, it hasn't split yet. I did not see any announcement. But the chart that we're seeing is pre-split, so the split won't help it. They may think it's going to help it, but this is a chart of a stock that's done. So I would never buy anything like this. And oh yeah, there is a 10-to-1 split coming up. You're right. So it's not going to help it. If you look at Tesla, when it had its split, it accelerated. It kept going. TTD, you can see, the earnings are going the wrong way. So, you had 92 cents, $1.27, 371, and then they dropped to 140. And Google's still, giving them some problems. So the stock split is not going to help them. So yeah, they may go, after a 10-to-1 stock split, if you own 100 shares at $507, afterwards you're going to own 1,000 shares at $50.70. But a stock split won't save it. Okay, and then the only other thing I was going to show you guys here is the main index that I'm watching right now is the spiders. Obviously there's the NASDAQ, there's the Russell. I do think the spiders are the most important index. And at this point, you can see that we do have a squeeze. The markets are sketchy right now. I think that we're going to see the spiders and the NASDAQ make one last set of new highs. And I want to emphasize that just because I think it's going to happen, it doesn't mean it's going to happen. But I'm right about 75% of the time. Let's put it that way. But I do think that we're going to get another rally to new highs into June. And then from there, I do think we're going to top and that we won't eclipse those highs for the rest of the year. So very possible that the June highs last for 6 months or longer. And that does not mean that, there's not going to be any buying opportunities, but it just means that, as a trader, don't worry too much about, which way the market's going, because you can make money in any direction. I mean, this looks horrible, but this was a really fun time to trade. This was a good time to trade as well if you were ready for it. But when markets go down like that, they're kind of designed, so where could it go? Who knows? There's a lot of support here. So maybe we get something, we need to come back down here. That part, I don't really know. It's more about identifying moments in time where a top is likely. And then, you get short, you buy puts, and you stay that way until you hit some targets or, the market shows that it's ready to reverse. And it typically will do that. If it's a down market, again, look at TTD. TTD is your case study for what a daily downtrend looks like. And notice here that what we're doing is we're hitting -2, -3 ATR and going back to the mean. -2, -3 ATR and going back to the mean, right? Oh, maybe, nope. -2, -3 ATR. So what it's doing is it's going to ride these Keltner channels down is what it's doing. In a bullish market, it's riding the Keltner channels up. In a bearish market, it just rides them down. All right. So good stuff. Let me come back and I will bring the link back up for any of you guys that would like to see that. Now I just got to find it on my computer. I'll show you the gold. All right, let me get this back up here so you guys can see that. And then Harley is just asking, do you use Kelly criterion to allocate capital? How do you know how much to risk and when to add and when to call it quits? No, for sure. So I don't use Kelly criterion. And in fact, I'm not quite sure what that is. So I'd have to look it up. What I do is by default is I will use, a 5% risk. So basically meaning that if I have a $10,000 account, I'm like, all right, I'm gonna put $500 into this option, and I'm talking with option trades, right? And if it's a $100,000 account, I'll put $5,000 into this option, et cetera, and that's kind of my baseline risk. I'll increase that if, like, say, is there a squeeze on QQQ and Google? that was the case in March. So if you have the indexes and a strong stock in alignment, then that's when I'll potentially risk 10% to 20%. Okay. Now that doesn't mean that I'm going to hold on to it until I lose 20%. It's just that initially I'm willing to give it that much room. If it doesn't work, maybe I do end up losing 5 or 6 or 7%, and it's just what I'm willing to risk. So if your goal is to make 20% a year, you don't need to risk that much. My goal is always several 100% a year. So I am taking larger risks. Simply because I am trying, I'm looking for bigger returns. And yeah, so Al's just saying, okay, so with TTD, could you short it on a pop to the mean? And the answer is absolutely yes. So the bullish trade in Google, I was like, okay, I'm going to buy pullbacks to the rising mean. Well, in TTD, you can short rallies to the falling mean. Absolutely yes. So the bonus, like on gold, so sometimes, you're going to get setups where there's a daily squeeze and a weekly squeeze, and that's a bonus. And a weekly squeeze can be a really powerful move. And, just a lot of power there. And so if we look at, bringing back gold again. So, if you look at these weekly squeezes, right? I mean, this was a huge move here in gold. We went from $1,300 an ounce to $1,600 an ounce. And then, got another little pop there. And then this squeeze right here, gold's going from 1,400 up to all-time highs. And so this squeeze right here, maybe we get to new all-time highs in gold. That I don't know. I just look at this setup as, when there's a squeeze, and if you look at prior squeezes, typically you're going to get up to 3 ATR. So that, that does mean that, hey, mid 1900s is in play. And I'm fine, getting out a little early if that's the case. But yeah, so that's what I'm looking at there. All right, guys. Well, thanks for joining me today. Again, I'll leave you with this link if you would like to check it out. We've got a trial to our room. I think for trading, I love trading, and I just it took me 8 years of pain and suffering to get consistent. And when I say consistent, that doesn't mean I never have a losing trade again. It just means that I have confidence in my setups that at the end of the year, I have a very high probability of being up some decent cash. And it's, trading by yourself is kind of boring. I wouldn't call myself an extrovert by any means, but, I don't like sitting alone all day, every day, because it's kind of, I don't know, what's the point? It's like I'd rather share, at least what I've learned. And so, that's what we do, and we've got a good rhythm in there. And it's me, I'm in there, but also we've got 18 other traders. So if you don't like what I'm doing, you'll like what Sam is doing, or Allison, or Danielle, or Henry, and which is always fun that way. All right, so I will leave this link with you guys, and thanks again for joining on Facebook Live, and hope to see you in the trading room. Have a great night, everybody.